Mike Sullivan. I'm a former IRS agent, teaching instructor with IRS as a revenue officer. I'm a national expert on IRS matters. I've been on all the major TV stations. Go to 777irs.com. I have a bunch of interviews there, and I've surrounded myself with a team of former IRS agents that have about 250 years of IRS experience. We're good and we kick ass. Why? We know what we're doing and we're fair and we're honest. Anyway, enough about me. I don't need a coat and tie. Like I said, I am a national expert, so I know what's going on behind the scenes being a revenue officer. Today I'm going to talk about the trust fund penalty. I'll explain it really quick, and the 4180 interviews. Those are two things that you need to know. As a former revenue officer, I set up hundreds and hundreds of trust fund penalties. So I'm trying to give you some information that you really need to know. So what is the trust fund penalty? The trust fund penalty is if you have a corporation and you don't pay your payroll taxes, your 941, IRS is going to come and assert a penalty against you, and they're going to go ahead and they can prepare those returns. If you don't prepare them, they're going to attempt to assert a trust fund penalty against you. What is the trust fund? The trust fund is the withholding and one half of the Social Security that you took out of the check. It's actually the money that you held in trust. IRS at that point, they're not really concerned with the matching portion or the penalties and interest. If IRS is going after the trust fund money, you can just look at your 941 form. They're going to look at the withholding and one half of the Social Security. If the company is in business, IRS wants to collect the debt, all of it. If it's out of business, and we recommend some people do this, IRS can only collect the trust fund. It usually is a 40% reduction of total tax. As a revenue officer, I've investigated the companies. I've set up the penalty. So what am I looking at? I'm coming into the company A to interview people, to look at who signed the checks, who signed corporate resolutions, who signed documents, who had the right to hire or fire, who ran the show. It's easy to find that out because I can get most of that information from the bank. And when I see a number of signatures on checks, I'm going to know who really controlled the company. That's not always the case, but most of the time. Then after you go and do your investigation and talk to people, it's easy to find that out. The key form that IRS uses is a 4180 form. You have to download it because that form can help convict you of the penalty. You must use caution in filling out the 4180 because that's a form IRS is going to dive into, and they're going to ask you very, very specific questions about who ran the company. So what happens if there's 4 people involved and I'm the RO, I'm giving those 4180s to the people who I think are responsible. So whatever you put on that form is going to be used against you for the assertion or the denial. Remember, there's a number of common law things, the things I mentioned and that 4180 interview. If you need a representation for the trust fund penalty, you should call me because I know all the defenses. But I want to tell you this generally, if you sign the checks and you own the business, you're going to go down for the penalty. There are defenses for that, but we're experts in IRS tax defense for the trust fund penalty. But remember, that 4180 form is really important, and I caution you to use caution filling it out. Talk to a professional like me about what you need to do. Thank you.